So hello and welcome to today's webinar on superannuation year-end matters. My name's Michael Jones. I'm a partner in the Melbourne office and I'll be presenting today alongside Clive Todd, a partner from the Brisbane office who specialises in superannuation. Clive, how are you going today?
I'm great, thanks Michael, and it's great to be reaching out to so many people using the wonders of modern technology across Australia and I'm sure the world.
Okay, good. So now, the format today of our webinar is in 4 parts. We'll start with year-end housekeeping, just classic matters that I hope will give you an understanding of fundamental issues and a prompt for some actions now in June. Then we'll look at the government's COVID-19 measures as it relates to self-managed super funds, and then we'll cross to Clive, who will cover strategies relevant for this time of year in this environment. And finally, we have a special treat for you. We'll have Professor Neville Norman and his view on how to deal with economics in the COVID-19 crisis. Okay, let's get started. The first point in the year-end housekeeping I'd like to raise is about having your minimum pensions paid out. It's prudent to make sure that they're paid by 30 June. Otherwise, the risk is you'll lose your tax exemption on your pension account. Now this year, because of COVID-19, the minimum pension's been halved, and this reduction is going to apply for this year, but also for next year as well. Now, managing pensions is important. Just to understand that, if you start a pension at 1.6 million, like you've maximised the pension, you can't simply increase the pension amount later once you've paid it down. So that means that if you're paying out a pension in excess of the minimum, then you're starting to use up your finite pension capacity if you're already at that maximum capacity. Look, now of course, if you intend to take out money, you should just take it out. But be conscious of what it means for the pension rules and the tax exemption rules. And there are ways of managing it. So for example, if you have a pension account and also an accumulation account, it's possible that you can instruct the fund to treat any withdrawals in excess of a minimum pension to be treated as a lump sum payment from your fund's accumulation account rather than the pension account. Instructions, and this is most important, the instructions must be provided before the event occurs. Now, if the member only has a pension account and no accumulation account, there is also something else you can do in that you can arrange, again by giving instructions beforehand, for any excess over the minimum pension to be a partial commutation. And this enables you to decrease the member's transfer balance account and give you space to top up more super later. Something to think about. Now, let's go to contributions going in. Of course, you've got to ensure that the contributions are received by 30 June. Now, an interesting point is that if you're doing an electronic fund transfer, those contributions must reach the bank account before 1 July. But if you're doing it by paying a cheque, all you have to do is give a valid cheque to the trustee before 30 June. Another point in this time, tax deductible contributions, $25,000. Just consider, is the value of the tax deduction you're getting, does that outweigh the 15% tax you're paying on those contributions when they go into the fund? There's something that Clive will be talking about in relation to unused concessional contributions, a new thing for this year. And lastly on contributions, consider your non-concessional contributions and what your position is there. And remember that if you're aged between 65 and 75, you're going to have to pass the work test. Let's move on. Reviewing capital gains and unrealised losses, a classic year-end thing. If your fund has made gains in the first half of the year and now perhaps is looking at significant unrealised losses because the drop in the asset values with COVID-19, you may consider realising some of those gains But the one thing I've got to say is that if the only reason, if you sell an asset to realise a gain and buy it back again, the tax office are very clear that they consider that tax avoidance. So you may end up having to do some explaining. It's all about what your intention is and how you go about it. We'll leave it at that. Next, reviewing an estate plan. I think this is an excellent topic for an annual review. Basically, when a member dies, their super has to be paid out. It'll either be paid out as a lump sum, or it'll be paid out as a pension, or a combination of those two. So when reviewing your estate plan, there's just two key questions that you have to be clear in your mind. That is, who is going to control the super fund and control those payments after the member dies? Alternatively, what document exists to control how your super gets paid out on death? Okay. The next one I'd like to raise in terms of year end is reviewing your investment strategy. Now, an investment strategy I think is actually a good thing provided it's meaningful. If it's not, I'm not very excited about it. One thing I can say the ATO have concern about is when a fund has just as mainly one significant asset. Like, for example, it may just have a property in it. And there's been some activity lately about considering whether that is appropriate. If that's your situation, then ensure that your investment strategy documents why having a significant single asset is a good idea. The last thing in terms of year end is a new rule. It's about superannuation guarantee opt-outs for high income earners with multiple employers. That really says it all. In the past, if you had multiple employers all paying a super guarantee, then you ended up automatically having excess contributions. There's now a way to opt out of one or more of your employers having to pay super guarantee. Check it out if that's relevant for you. Now, I want to move quickly on to how the government COVID-19 measures and relating particularly to self-managed super funds. The first one, minimum pension reduction, we've already covered that in a sense beforehand. I'll just make a couple of other points. Basically, your excess, any excess, it can't be paid back into the superannuation fund. That anything going back into the fund will be a contribution, so you can't pay them back in. Secondly, you can't retrospectively classify that payment as a lump sum payment. And thirdly, pensions that have started halfway through the year or some part through the year, you can apportion the minimum pension. All right, early release of super savings. I mean, this is amazing. 10.6 billion has already been withdrawn under this early release scheme. Something I find, if you need the money, take it out, but otherwise I'd be very cautious of raiding super at this time. Basically, the way it works is that if you're eligible, you can take out money and you'll not be assessed on it. To be eligible, and if you are eligible, you can take 10,000 up to 10,000 out before 30 June, and then a further 10,000 in the period from 1 July to 24 September 2020. To be eligible, you have to be unemployed, or you have to be eligible to receive job seeker or similar type payments, or from 1 January 2020, you've been made redundant, or your work hours have been reduced by 20%, or if you're a sole trader, your turnover has reduced by 20% or more. Two comments, I just repeat. I think it should be a last resort for early release, and also the ATO monitor it closely, because when it was announced, there was some significant fraud around identity theft in this area. Okay, next relief, rent relief and arm's length arrangements. So what I mean by that is the government has changed tenancy laws to protect tenants and enforce rental relief for tenants, okay, provided they're suffering financial hardship related to COVID-19. Now, this relief is also available between a self-managed super fund and a related tenant. The key, if you want to undertake this rent relief, the key is that the arrangement has to be at arm's length. And I would also consider, is it really in your best interest to get rent relief? You just have to go through, not something I would do automatically, but it is available provided the arrangement's at arm's length. Similarly, we've seen relief provided by banks when you have a related party borrowing between a super fund, and a related party. You can also have an arrangement which gives the lender or the borrower some relief due to COVID-19. The point is, in the same way as the commercial banks are providing relief to borrowers, a related party can also provide relief to a self-managed super fund. Again, just ensure that the transaction is at arm's length and it's documented, and the ATO should have said in those circumstances they'll be okay with it. Just document why it's arm's length. But also I would consider, is it in your best interest? Maybe, that limited recourse loan, you're better off getting rid of that as quickly as you can. Something for you to consider with your advisor. Lastly, in this area, I like to talk about in-house assets and lower asset values. So an in-house asset, basically it's a asset that's connected to related parties, and they can't be more than 5% of the value of the fund's total assets. So when you have a downturn in the share market like we are experiencing at the moment, sometimes you can end up breaching that in-house asset rule because the relative values have gone, and what was below 5% of the market value of the super fund assets is now above 5%. The way to solve that is you have to do a written plan about rectifying the situation. Now, what the ATO have announced is that if you have a written plan, because these plans the rectification has to occur within 12 months, like within the end of the next financial year. If you were unable to succeed in rectifying the situation because of low asset values continuing, then they won't be pursuing any audit activity in that area. Okay, so that was the last sort of COVID-19 measure for self-managed super funds as far as I'm concerned. And now I'd like to hand over to Clive to talk about strategies. Take it away, Clive.
Thanks very much, Michael, for that comprehensive overview of what people should and could be doing in the lead up to 30th of June. I'm going to just give a bit more information about some of the things Michael's talked about and some other strategies that might be hopefully relevant at this time with all the COVID-19 impacts that we're suffering from. Firstly, I don't meet the criteria to access my super due to the early release that Michael talked about for COVID-19. Are there any other options? What else can I do? If I need money or I would like to get some access to my super, is there anything else I can be doing at this time to take some money out of super? And the other point here is $10,000 might not necessarily be enough. Like, it's great that people can access it if they do need to as a last resort, but if you've lost your job or something, maybe that's not quite enough. So let's look at a couple of strategies around that. Firstly, there's the classic meeting a condition of release. So via account-based pension or a lump sum. The condition of release, the two common ones are mainly turning 65. So if you're aged over 65, you've got full access to your superannuation. You can take it via an account-based pension or as a lump sum. Secondly, the other common one is you're ceasing an employment arrangement. You have to reach your preservation age to then cease employment. Now, your preservation age is likely to be between 55 and 60, depending on the year you were born. And there's some rules around then that ceasing of employment. If you're under age 60 is your preservation age, you need to cease employment with no intention of returning to work. If you're over 60, slightly different. It's a bit more relaxed in that you only have to cease an employment arrangement and then you've got full access to your super. So slight differences there. Now, unfortunately, with the timing of what's going on in the world, people may be losing their jobs. They may be ceasing an employment arrangement. And it doesn't have to be your only employment arrangement. I think that's a good point to make too. People with multiple jobs, if they're aged over 60, they can just stop one of them and that gives them full access to their super. So something to consider if you are looking to access your super and you meet those criteria, there's an option to do it via an account-based pension or lump sum. Transition retirement income streams. Now these have been around for a long time. They lost a lot of their attraction with the reduction in the tax benefits a few years ago, but they are still there as a viable strategy to access some of your super and supplement your income. Now, it used to be like in the classic term of if you're reducing your working hours to transition to retirement, you could do this. Again, unfortunately in the current climate, maybe people are in need of accessing it for other reasons. The only criteria here is you need to have reached your preservation age. So between 55 and 60. The big difference here, apart from the tax benefits, is for the transition retirement income stream, there is a maximum amount that you can take out. So you can only take out up to 10% of your superannuation balance each year, whereas with an account-based pension, or if you've met that full condition of release, you can take out your entire balance if you so wished. I've got here mentioned as well in-house asset loans. Now, Michael briefly mentioned these before, and no, it's not a bad pun about isolation. They actually exist. They're in-house assets, and it's where in certain circumstances you are able, like your super fund is able to lend money to certain related parties. Now, I'm not going to dwell on it too much because there are more restrictions around these than a Queensland border, but it is something to be aware of, and I can only stress that you should talk to your Mazars advisor if this was something you were thinking about or doing. And again, like any investment inside of superannuation, it does need to be done for the sole purpose of providing retirement benefits to the members. You need to make sure that's the driving motivation behind anything that you do. So there's some of the ways that you can be accessing your super at the moment if it needed to be. Next, unfortunately, unless you've been solely in cash or you've heavily invested in hand sanitizer companies, the chances are your superannuation balance has decreased in the last few months. Is there a silver lining to that? Is there any benefit out of this decrease? And while it may be cold comfort, I think there are a couple of things that a couple of strategies that we can sort of talk about that may be of benefit moving forward. Firstly, I just want to cover off on the concept of total superannuation balance, TSB. So this is a concept that came in a couple of years ago, and effectively it's the value of all your superannuation interests. So not just in a particular fund, but across all your superannuation funds. And there's a number of things linked to your total superannuation balance. So that's what I'm about to talk about. But given that it may have decreased at the 30th of June 2020, it could be opening the door to some of these strategies that I'm just about to cover off on. Firstly, the things linked to your total superannuation balance, you've got your non-concessional contributions, your carry forward concessional contributions, and there's the work test exemption, which is new. An important point here is that it's linked to what your balance was in the previous financial year, so at the 30th of June of the previous financial year. So if your balance at 30th of June 2019 was X amount, that is what it's based on for what you can do up to the 30th of June 2020. So the decrease in the value in the last few months won't necessarily help for this year, but it may create these opportunities for next year, as I'm about to talk about. So the timing of that is important to know. It's the 30th of June in the previous year that it's assessed at. Non-concessional contributions. So these are the after-tax contributions that you can make to super. They're tax-free going in, and you claim no tax deduction for putting them in. You can do up to $100,000 a year, or if you're aged under 65, you can do potentially up to $300,000. The crucial point here is, though, that they are linked, that what you can do is link to your total super balance. If you've got more than $1.6 million in superannuation, you can't make any non-concessional contributions. So I think you can see where I'm going with this from an opportunity point of view. If at the 30th of June this year, your balance has decreased, it may be opening up that window of opportunity next year to make a non-concessional contribution. So an example of that, you had $1.7 million at the 30th of June 2019, 30th of June 2020, with the markets the way they are, it's dropped down to $1.5 million. You can suddenly make a non-concessional contribution of $100,000. So that could be something to keep in mind. Another good point around non-concessional contributions is that they don't necessarily have to be in the form of cash. They can also be via an in-specie transfer of acceptable assets, which include listed shares. So you can almost get a bit of a double whammy at the moment of the benefit of transferring in some of your shares that you hold personally at a lower cost, realising a lower gain or potentially a loss in your own name, and getting those shares into the superannuation environment so that the future growth is in that concessionally taxed environment. Again, seek advice, look at your situation. It's important to make sure that you know the full ramifications of doing any of these things, and you don't breach any caps, and you don't sting yourself with a big capital gain. The carry forward concessional contributions. So Michael alluded to this before. Now this is a relatively new concept. Since the 1st of July 2018, if you don't make your full $25,000 concessional contribution that you can do in the year, the unused portion is actually carried forward for up to 5 years. So that's a bit of an advantage at the moment, I see. Like, we're getting a lot of questions where people are going, I can't afford to make my contribution this year. Is it lost? Or it may not make sense to make the contribution. If you don't have taxable income, do you want to be putting in, or can you put in enough money to get your maximum $25,000 concessional contribution? If you don't, that unused amount carries forward for up to 5 years. The catch again here though, and the linking to the total super balance, is that you have to have less than $500,000 across all your superannuation to be able to put in those catch-up contributions. Now this is something that's assessed each year. So in a particular year, your TSB might be more than $500,000. Your contributions still carry forward if they're unused, but in the next year or subsequent year, maybe at that point your balance has dropped down below the 500,000, and you can make a contribution, a bigger contribution at that point. There's a bit of a summary of some of the, like an example of that. So in the table there, so you can sort of see the power of it. If you're not making those contributions, how it can build up, and you can see in like that example in the 2022 financial year, your cap's actually $60,000. So you could make suddenly up to $60,000. If you don't make any concessional contributions in a 5-year period, you could put one big hit of $125,000 in, if it made sense, and if you had the cash flow and you got a tax deduction for it. So carry forward concessional contributions, another strategy that we might see used more, especially with people slipping under that $500,000 total super balance. Work test exemption. Now this is brand new from the 1st of July 2019. Just to cover off on the work test again, that is, if you're aged between 65 and 74, you have to actually be working to contribute. You have to have worked 40 hours in a 30-day period, so you can actually then make a contribution to super. The allowance here with this, the exemption with this work test exemption, is that it gives people the opportunity for a further 12-month window to make voluntary contributions. So the example there is, if you cease work in June, a 67-year-old ceases work in June in a particular year, they can then make a contribution in the next financial year as well as the year that they ceased work in. So normally you wouldn't be able to do it. You'd have to be working to be able to contribute. The catch again, and the linking to the total super balance, is you have to have less than $300,000 in super across all your super funds. So potentially with the depressed markets, maybe that's opening up the opportunity for some people this year that have retired during the year, and they're going, I'm never going to be able to put money in, my super balance has come down now. Well, maybe the window's there for them to do this in the next year. And again, it's a moving thing each year. Like your balance, it's assessed at that 30th of June. So depending on the situation, it might create the opportunities. You can only do it once though. So if you've done it already taken advantage of it in a particular year, you can't do it again. So keep that in mind. So I'm talking a lot about the total super balance, and one is if you're close to it, like you're just above it or you're getting up to it. Is there anything that can be done to sort of manage that, to give you the best opportunities that you can, to take advantage of some of those strategies that I just talked about? And that, yes, there is. The most obvious one, if you meet a condition of release, you could take money out. So you can literally withdraw money, either via pension or via a lump sum, if you've met that condition of release. So you could find yourself in the situation where by withdrawing $20,000 from super actually gives you the opportunity to make a $100,000 contribution if you're around close to those thresholds. So withdrawing money from super, a fairly easy one, but something that does take monitoring and managing. Contribution splitting. Now this is something, an underutilised I think, and a relatively unknown strategy that's around. And what it involves is where a person can split their concessional contributions that they've made in a year over to their spouse. So they can do up to 85% of the contributions that they've made in the year, they can split over to their spouse. Now there are some sort of conditions around it, but on a whole, it's a way of being able to not only keep the person's balance down, it's not going to reduce it much because you obviously have to make the contribution in the first place, but it means you can maintain it at a certain level if you're splitting them over to the spouse. But it's also a way for your spouse to potentially build their super up so that you get that equalisation and that both people are then getting the maximum benefit that they can from their superannuation. So contribution splitting, again, talk to us about it. It's not necessarily relevant for everybody, but it is something, if you're around those thresholds, keep it in mind. Tax effective accounting, now we're getting into some of the accounting techniques, and this is why you have us as Mazars accountants to assist. If you are, again, around those thresholds, what can be done is, in the financial statements, the deferred tax liabilities can be recognised, which is essentially where you may have a future gain that you might be realised and tax payable on that. That can be brought to account and essentially reduce your balance. And another thing there, I haven't got noted, but you can also account for disposal costs in your market values. So in other words, you've got a property worth $1 million. If it was going to cost you $30,000 to sell that property at some point in the future, you can actually value that property at $970,000. Now it might not be much, but if you're around about those thresholds, it could make a big difference. So disposal costs, tax effective accounting, and then contribution splitting are some of the more, I guess, different, more not necessarily widely used strategies. And then obviously the withdrawals from superannuation. Keep that in mind. Unfortunately with that one, you've got to meet the condition of release, but it depends on your situation. Now another common question that we're getting, unfortunately, at the moment with the downturn in the market. I've previously commenced a pension with $1.6 million. That's now dropped in value. Can I add to it? Just to refresh everybody's memory, the $1.6 million is the magic number that the government says you can put into pension phase, that you can apply to pension phase and get the full tax benefits of having that pension in place, which is no earnings tax on any income generated by that pension. So that is where it is at the moment, $1.6 million. There's talk about that might be raised in the next year or so, depending on the CPI, etc. So, but at the moment it's $1.6 million. So if you're in the situation where in the last 12 months, for example, you commenced a pension with $1.6 million, you may be seeing that that's now $1.4 million. And you'd be sitting there going, can I top it up? Like, this doesn't seem fair. I've got this other money in accumulation, or I can now make a contribution. Can I put more into that pension to get back my full benefit of $1.6 million? The short answer is no. Unfortunately, you can't. Like, you've used up your entire transfer balance cap, which is what it's called, that $1.6 million. So that's it, done, gone. You can't put any more money into pension phase. So if it has dropped, unfortunately, that's your pension now. The silver lining there is, I guess, you have to take out less. Your minimum pension would have reduced the amount you have to take out. But again, that's not much good if you're just still wanting to take the money. You need the money to live on. that's not really of much comfort. Now, it's important to note that the reverse applies. Like, I think at the moment we see the balances coming down, and people are probably like, I see you at the moment shaking your heads and going, this isn't fair. But let's not forget the other way. If you started a pension with $1.6 million and it's suddenly worth $2 million, well, you don't have to be bringing it down to $1.6 million anymore. So in rising markets, there is that benefit. So you get the good with the bad. Unfortunately, at the moment, it's mainly around the bad. But that's the pensions, and that's pretty much all I've got to cover off on today. I hope there's been a few strategies there. Like, I reiterate what I've said a few times through. These are all applied to people in different circumstances. So each person's individual circumstances need to be assessed. You need advice around this. This is all just general advice, so you need to talk to somebody licensed to give the advice, which we are. So please reach out to myself, Michael, or your Mazars advisor, and sort of talk to them as to see whether these strategies can apply.
Okay.
Back to you, Michael.
Okay, good. Thank you, Clive. Thank you, Clive. I think that I love your silver linings. You've had to have been struggling to find some silver linings at the moment, and you've done well. But also for the very practical suggestions and a review of the fundamental rules of superannuation. I think it's helpful for everybody. We'll also be putting out a year-end superannuation guide. It'll be up on our website in the coming days, probably by the end of, in about a week. Okay. Now, let's go to the next part of our session, which is the economic outlook by Professor Neville Norman. A brief introduction. Professor Neville Norman, he's taught economics for decades at the University of Melbourne and the Cambridge University. He's a leading economist and a prominent public commentator. What he's done for us this morning is put together his views about how economics can try and cope with such a dramatic impact as the COVID-19 influences that we're experiencing at the moment. So now let's go straight into it and hear from Professor Neville Norman in a pre-recorded presentation.
Thanks very much, Michael, and hello everybody in these strange times. This is Professor Never Normal. I've never been normal and we're never going to be normal again. I'm speaking to you from Cambridge in England, where I came for a 6-week trip to our second home, which is rather nice to be marooned in, and we're going to be here for at least 6 months. Well, I've got something special for you, and I'd like to thank Mazar and everyone who's made the effort to be involved in this. I have really serious stuff. If I make light of it, it's not being trivialised. But here I am in a country I didn't expect to be at this time. We were having 2 trips. We normally have 4 to England, and there's only going to be 1 this year, and I'm not sure we'll be out by the end of it. Let's start with looking at 3 histograms for the daily deaths, to set the scene, in the United States, the UK and Australia. And you can see, if you look at the scale, still a massive problem in the first 2, but thankfully the lucky country has just about eliminated it. We can never say it's gone. It's like cancer. You can never say it's gone. Maybe I should have escaped a week after we got here, which was the option, because we ain't going to get out soon. Well, what are we doing? This is my agenda. There's 7 points here. I'm going to look at economic forecasts that we made as recently as 2 months ago, and then why they've changed so radically, how we did them, and this is as relevant to your business as it is to forecasting the economy. I'll give you the punchline. We cannot, for a long time, use any of the data and any of the tools that we did for forecasting before. Let me show that by going to a quick summary slide of Australian economic forecasts from the Treasury and the group of economists known as Scope, gathered up by the Fairfax papers. Many of you will see them, I'm included. I had a hand in starting it a long time ago. Now, GDP, or Gross Domestic Product, is an economist's term for the magnitude of the spending and production and income of the whole economy. It sounds strange, but it's never been more important, because where that goes drives the jobs, the deficits, the debt, and pretty well the profits and spending base of everything in the economy. Can't emphasise it enough, so please tune into it. Well, what do we reckon? The Treasury has been on a track of about 2 to 3% growth for the next 4 to 5 years. They didn't know about the virus, nor did any of us. And you can see they were forecasting 2.75% volume growth for the fiscal year. We've got a funny one in Australia. In some ways it's better to have calendar years because the virus came at the start of a calendar year. But let's stick Australian, and we've got a fiscal year ending on the 30th of June this year where it's not going to be a positive growth at all. In fact, by the time we get this belatedly about September, it will be pronounced a recession, and I can't think of anything more definite than that. But how bad, and what about the next year? Well, as you can see here, even Dr. Doom and the doomsayers did not believe there was negative growth for that year. That is 2021 ending in June 2021 over the year before. What about the next one where we look at unemployment rates, which are geared? Well, with unemployment rates, we've got a percentage of the workforce. The Treasury says, well, it's always going to be around 5%. The scope forecasters said, well, more or less. The most pessimistic was close to that at 6%, and the most optimistic was 4.8%. And I'll just take another one because there's so much we could do in limited time, the budget balance. Well, that's always had minus signs as far as we can remember. And of course, with great joy, the Morrison government has been proclaiming, we have got a surplus. Well, nonsense. All they did was give a forecast, and there's no way that's going to be. And the question is, does it stay under 100 billion? So this is real change. But this is what we looked like at the time. Now, a little review. How on earth do academic and consultant economists do this? Well, you've got a choice. You can use the JAG method, which means just a guess. And I'm going to allege that by reductio ad absurdum, in other words, excluding everything else, most of the stuff you're getting is sheer guesswork. So the first aha for you is interrogate everyone, including me, and I'm sorry I'm not there to crunch me, about how the hell they've done it. So before the virus, we were using models with a lot of mathematics and a lot of data. And all these models are very hungry for data. So we have lots of past data, things called distributed lags and so on, and it can be very fancy. Now, you won't like this slide, but the standard thing we teach and use is a vector autoregression method, which is a mathematical combination of distributed lags of past data. It is really ugly, and I've got great news. For the next 2 years, you do not have to learn this and do it. I've got something simpler that is vastly better. You'll be delighted to learn that. So here we go. Here's the first shock. Watch the red numbers. Instead of predicting slight positive growth, and we used to agonise and debate whether growth was 2.257 or 2.198. Here's the range just 2 months after the Age and the Sydney Morning Herald and the others published our forecasts in February of 2020. Look at the numbers. The most optimistic believes that the growth will be minus 6%, and the most pessimistic has got it near to a 20% annihilation, a fifth of the economy gone. Unemployment, not a 5% growth, but between 10 and 20 more or less. And a budget balance, not creeping into the positives, hooray, 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 but back to deficits, more spending than tax revenue for the federal government of, you pick a number. And I'm going to talk to you about how they get this, because I don't know exactly, but I know what they didn't use, because I'm going to show it's absolutely impossible. Look at that, big, big numbers. Now, there's a lot of other things we can do, but let's focus on those. And here's this question. What on earth happened to create the biggest change in economic forecasts we have ever seen? Compare the red figures with the others. This is the blunt reality, and please look at this carefully. There is, verbatim, no mathematical combination of the data we had up until a few months ago that any conceivable known mathematical model could use those data, that's the correct English, not that data, to generate the red figures in the slide before last? None. So I don't know what they used because I'm not inside them. I'm going to tell you what I use, but I know what they didn't use. So how were they concocted? A new world needs a new approach. So welcome to VEM, the Virus Economic Model. This is the first, quote, public, unquote, presentation in Australia. You're getting it first. The model involves virology as well as economics. It's built on a chronological platform. It uses computers, and I haven't time to do it here, but you can read all about it on the Mazar website. The great news is even simpler methods work than the most complicated one. As my best man of long ago, John Wilson, said, even a child of 9 could beat the computer experts. Well, there it is. This is the virology. You've seen it. Unlike the virologists who know nothing and care nothing about the economy, and unlike the echo freaks who know nothing about virology, I've had to study both, and this is the virus model. You get a sequence over time that rolls on every day, every minute, where there's a sequence of cases which are infections and deaths and reactions from the government, and they include restrictions like lockdowns, but there's a whole lot of other things which in the country I am, Britain, is making a pig's breakfast of doing, and that's why the numbers are so bad. That's why I fear that I'm here in the UK and you're in maybe the second safest country. Let me give you the conclusion. I'm happy to be the treasurer in the New World Government as long as Jacinta Ardern is its president. Let you think about that one. So that's the virology, and this is how it fits in with the economics. The cases or infections go on to the deaths, and by the way, that R statistic is not a constant that is available to each. It changes all the time, and sometimes it's below or less than 1. It's miles less than 1, so that in terms, if you've done any physics, you've got a damped system where the deaths are heading towards 0. But watch out. The virologists are still there. They won't die, and they're screaming and scaring you with the second wave stuff. They may be right. Anyway, come back to that at the end. So you get the virus restrictions which have immediate effects, and we need new words and new approaches to do it. And the good news is they're simple. And then, of course, they go back. Link 4, they should be impacting. Well, there's not a lot of sign. It's a very deadly slow process in the UK. So what are the new tools? The first one is that the National Income Identity, GDP, of consumption, investment, government expenditure and net exports has to be redefined. First of all, investment has to be used in its English language way. In other words, it's not what most of you think of sloshing money on the stock exchange. To economists, it's capital equipment spending. So let's look at this slide and see that we've got A, B and C. I'll tell you what they are in a moment, but A and B are the consumption goods. Never been broken up like this before. C is the capital equipment. You don't have to do it. It can stop in a crisis. And government spending, well, this features. And I've cooked this by making exports and imports equal to each other because it makes it easy. So A goods are 40, B goods are 25, C is 10, the government is 25, which is 25% of what adds up to 100, and that's what you might have had, 100 big units for the size of the Australian economy or any economy in 2019 before you know what hit. So what are A and B? A are the goods that will be allowed, there's nothing illegal against them, in the virus-prone economy. And B are the goods that are either banned outright or bludgeoned and knocked out indirectly because there is an effect. For example, suppliers to airlines. Example, booksellers at airports and at rail stations. They are butchered, not because it's illegal, but like travel agents, because there's nothing to do. What's the second tool? We're ready for it? Here it comes. It's the scoop. Now this is the new tool because it explains more than all the computers and mathematics I've ever learned and taught. And here's your next tool, a simple calculator the child of 9 could use. So what do we do about the B products, the bans and butchering? Simple. We just work out what percentage of the economy they are. For your business and your sector, what percentage are the things that at the full strength, and that's a variable in my model, of the restrictions were there. Well, now we don't even know what the GDP numbers are for the March quarter this year. And we know that the worst is going to be in the June quarter, which we're now in. So we've got another month to go. And on these numbers, we've got a 20% drop in the annual equivalent, and that's 5% to the contribution given this quarter. I'm assuming the bans are eased from the 1st of July to make it easy, and I'm giving you 3 scenarios. And you can scroll these in your own time. I've got to do them fairly quickly. Scenario 1 is a smooth and careful easing. And I think you can risk that in a country like Australia because you've done so well, and New Zealand's already done it, and we're close to it. Well, we've got on my numbers to complete the year before, which ends in a month, a 4.7% drop and a certain recession. That's bad enough, but many countries will be worse on the financial year ending on the 30th of June 2019. And on these numbers, you can see the severity index, which has got the restrictions easing. 100% is crippling, and 25% by the end of the next financial year, we've still got some restrictions because it's smooth and careful. The GDP index, huge amount of calculations, using no more than the scoop and the calculator. That's all you need. You've got a bit of an improvement, but still not back to the activity rates in a year's time that we had in 2019. I'll leave the budget balance because that's for another time, but for some people that's pretty scary. The second one is, suppose we go a bit more aggressive. Look at the severity numbers. We drop the severity down that all restrictions are gone for the June quarter 2021, and we're certainly back, as it is logical, using the scoop and the calculator to a growth that is now positive. The last one is exactly the same severity for the rest of this calendar year, but then, sorry to scare you, but I've got to build it in to scenario planning. We've got the second wave. So towards the end of this year, it all comes back. And so back go the restrictions, back go the government spending, which incidentally will help. And so that cushions the blow. And it's not a great outcome. It's probably better if we had that. But what probability do you give that? Are these scaremongers telling you about second wave? Are they 1% or 10% people? The implications for investors and interest rates. Obviously on these scenarios, the paranoid obsession with central banks, including our paranoid obsessive Reserve Bank of Sydney, is to keep the interest rates as close to zero, and that's going to keep going despite what any of us say. And that'll mean the stock market will be able to recover, and I think gain about half by the end of this year or the next financial year. So there's good news there for portfolio including superannuation people. The second one is that it's even more productive, and to finance the deficit with higher interest rates and to respect that, the way central banks work, not my choice, then interest rates will be rising in scenario 2. Don't ask too much about scenario 3 because it starts well and then ends in yet another stock market crash. And the probability of that makes my point. You've got to do virology or epidemiology as well as economics. You've got to build in the probability of a second wave crash. So what's the implication for the economist models and the data? Until later 2020, when we get a bit more data, using the calculator and the scoop will get you so much closer to forecasts that seem credible than any data and model. The 9-year-old child will do it better than an econometrician. And for your own sectors, as they resume, especially if you've got B products that are either banned or butchered, you need to think about some of these things. What's the truth about the epidemiology and this distancing? By the way, you notice I don't use the term social distancing. It's bad English because it's nothing social about this. It's anti-social distancing. If you like, it's physical distancing or just distancing. Let's get this right. Unfortunately, the President of the USA, from whom all wisdom comes, including bleaching to fix the problem, has told us social distancing. Try this one. This comes from a consulting report that was published about how you can reconfigure a restaurant. Now, the microeconomics of this, which I'll work on with another day, and some of you need to look at, is that if you have to put a restaurant with a 2-metre distancing instead of 1, it goes bust. But it all depends on the ratio of fixed expenses that are there no matter how many people you put into the restaurant or whatever you're producing compared with variable ones. Michael, you'll go to town on that one. The common virus fallacies, I'm a bit of a pedant here, is that the damage didn't come directly from the virus. The economic damage that we're all suffering came from the rules, but they came from the virus. The lockdown is not the only thing that affects the viruses, and the United Kingdom is a classic example of where an unprepared government with unprepared health system and maybe issues of hygiene and compliance are doing as much as the lockdown to explain the progress or lack of it. On that matter, if you're isolated, bad luck. Don't tell anyone you're isolated unless you've got the disease. You should be quarantined. Life-saving goals or economic damage are the two balancing issues that are in my model. You can identify extremists who only care about saving lives, like the epidemiologists, or the materialistic moguls who don't care about that. Somehow, governments have to balance this. And how do they do it? Do they use models or guesswork? Well, I allege that unless they're doing something like I've revealed to you, most of my colleagues, academic or otherwise, are just guessing. So we've got to get rid of the old models until we've got enough data and understanding. So let's bring this to a head. Sorry that it's had to be cannon gun, but I've had to pack so much into this. Watch out for the bad English. Watch out for the second wave. I've showed you what a difference it makes to the economics. If we do have a second wave, and predictably all things go belly up and the government's got to step back in with restrictions, saved a bit by these stimulus packages like JobSeeker. We need to wait for the data to come, but we don't need to wait forever if you use the scoop and the calculator. Watch out for political jackknives. Best example is the country that I'm in, where they were having no lockdown until one mathematical model with no economics in it, from a person who had some personal difficulties complying with it, convinced them to get rid of herd mentality. And then you've got compliance and enforcement. If the lager louts are not going to do the proper distancing, then you get a Faulkner McDonald's or a Ruby Princess, which are embarrassing issues that Australia has given to the world. And watch out for sad economists. The traditional economists that think everything is done by supply and demand won't understand, won't implement the scoop or the calculator. They'll stick with the old stuff, mislead you, and you need to sort them out. Supply and demand doesn't work in a world of bans and butchering. Best wishes from me. If you want to find out more about me and how I'm coping with this personally, I'll tell you. Send me an email. Stay safe. Safeguard your bodies, your businesses and your planning progresses. Ask and scream anyone who forecasts anyone how they do it. It might just be pure jag, just a guess. Good luck.
So there you have it. Viral economics from Professor Neville Norman. I think it's a great effort by him to understand how we can try and account for COVID-19 in economics, because we can't do the mathematical modelling that used to be available. So I hope you found it useful, particularly the references to gouging. What we hope to do is perhaps have some more material on Neville Norman, and we can put that up on our website down the track. If something we spoke about today struck a chord with you, then what I do is I encourage you to check in with your Mazars advisor and discuss your particular circumstances in relation to superannuation. Also, there will be a year-end super guide, as I mentioned, putting up on our website. Thank you for joining us today. A recording of the presentation will be sent to you following the webinar. You'll be able to watch on demand by clicking on the same link that brought you the live webinar today. Thank you very much, and thank you for joining us. Goodbye.